You're listening to Decoding the Times, a channel that talks not only about finance, but also helps you understand how the world truly operates. The 90-day truce between the US and China may appear to be a strategic retreat, but behind it lies a complicated chess match where both sides are silently calculating their next moves. In this podcast episode, we don't just deliver the headlines. We dive deep into strategy. Why does Trump need the Fed to cut interest rates at just the right time? Why is China willing to step back, despite the pressure? Why are technology and supply chains the silent but critical battlefields? And most importantly, what will really happen after 90 days, and what should you start preparing for right now? Buckle up. The war without gunfire has already begun. Welcome to the most in-depth and realistic macroeconomic analysis of May 2025. To begin this journey, let's go back to May 12, 2025, when the US and China unexpectedly announced a 90-day pause on tariff escalations. The media called it trade peace, markets rejoiced, and investors breathed a sigh of relief. But was this truly a gesture of goodwill or just a temporary mask, concealing a chess game that's heating up day by day? Welcome to Part 1, The Mask of Truce, when Washington and Beijing signed what everyone knew was temporary. Part 1. The Mask of Truce. When Washington and Beijing signed a deal everyone knew was temporary. On May 12, 2025, Washington and Beijing made a surprise announcement of a temporary trade agreement substantially lowering bilateral tariffs for 90 days and reopening bilateral ministerial-level talks. The S&P 500 immediately rose by 2.9%, and the Nasdaq surged over 4%. Media headlines declared, "Trade peace returns." But was that really the case? In truth, this was not a comprehensive agreement, but rather a ceasefire. It was more like two exhausted fighters retreating to their corners for a breather than a handshake driven by goodwill. The core elements of the agreement can be summarized as follows. The US reduced import tariffs from 145% to 30% for 90 days. China lowered tariffs on US goods from 125% to 10%. China temporarily suspended non-tariff measures such as rare earth export restrictions. Both sides established a new ministerial dialogue mechanism to continue discussions. However, what the agreement didn't include is even more telling. No commitments on intellectual property protection, forced technology transfer, or industrial subsidies, the three red lines the US had previously insisted were non-negotiable. No mention of restoring strategic supply chains or addressing structural trade reforms. No enforcement mechanisms or penalties in case of violations. In other words, both parties have merely hit the pause button without resolving any of the core conflicts. Why did they do this? The US is facing negative growth and stubborn inflation. China needs to de-escalate tensions to avoid a broader economic crisis. This deal is like a strategic emergency room, stabilizing US market sentiment, buying China time for domestic recovery. A notable detail: both sides avoided any victorious rhetoric. Trump didn't boast of a win. He simply stated, "This is a necessary step to ensure fairness and stability." China didn't hold a formal signing ceremony, just issued a brief press release stressing that the two sides need to continue discussions. This is political wisdom. When you're unsure whether the deal will hold, it's best not to oversell it. No one wants to look foolish if everything falls apart in 90 days. Among analysts, many have called this a paper marriage between two quietly rearming rivals. It may sound dramatic, but perhaps it's accurate. One big difference compared to previous tariff ceasefires is that this time, neither side was pressured by public opinion. Both the US and China voluntarily returned to the negotiating table not because one side was stronger, but because both sides needed it. That makes the deal fragile, but also better reflects the delicate power balance between the two superpowers. Both Washington and Beijing understand a trade war isn't the goal, it's a tool to restructure the global power order. And sometimes, the best way to move forward is to take a step back, tricking your opponent into thinking you're weak. And it's precisely in this seemingly quiet moment that the real game begins. In the next part, we'll break down Washington's tactics. Why did President Trump, known for his aggressive style, choose to back off? And what lies ahead for the Fed behind the smokescreen of inflation? Part 2. The Trump-Fed Dilemma. The 90-day inflation trap and the battle for policy control. Why did Donald Trump, a president famously known for never backing down, choose to call a truce with China right when the US economy had just recorded negative growth? The answer lies not in weakness, but in a masterstroke of strategy, setting a policy trap to gain control over both the Fed and the market. The 90-day tariff suspension wasn't just a concession, it was a coordinated move to manipulate inflation expectations, paving the way to pressure the Fed into retreat. With tariffs paused, cost pressures ease, and CPI cools in the short term. When that happens, media, markets, and businesses all start chanting in unison. Inflation is down, cut interest rates now. If the Fed follows through, Trump secures exactly what he needs: lower interest rates, right when he plans to inject money into domestic industrial programs. It's something he couldn't fully achieve in his previous term due to Powell's steadfast opposition. Unlike 2019, this time Trump isn't just applying verbal pressure. He's using policy, and more subtly, the market itself to bend the Fed's hand. And the most fascinating part? The market is voluntarily helping him. Within 48 hours of the deal's announcement, the Nasdaq surged over 4%, the S&P 500 nearly 3%, gold cooled, and bond yields dropped, all signs that investors believe the Fed would soon soften. That's the moment Trump can strike again. If the Fed cuts rates, he can reimpose tariffs, this time deeper, broader, and with less market panic. At that point, Trump would control all three pillars of economic power: monetary policy via a compliant Fed, fiscal policy through looser spending, trade policy through tariffs, a position no U.S. president has held since Richard Nixon. With legislative tools like the CHIPS Act and IRA in hand, Trump's administration could ramp up domestic manufacturing, protect strategic industries, withdraw critical supply chains from China, and restructure the economy toward industrial sovereignty. But the central question remains: will the Fed take the bait? Powell may try to maintain neutrality. But if over the next 2 months, inflation cools, unemployment stays low, and markets rise, the Fed may be pulled indirectly into Trump's policy orbit. If that happens, Trump won't just hold an economic advantage. He'll gain a political weapon for future strategic maneuvers, reapplying tariffs, renegotiating with Europe, or redefining the dollar's role in international trade. What's concerning isn't just what Trump might do, it's the fact he's already laid the groundwork for every scenario with one calculated step back. Even more critically, if the Fed cuts rates, Trump could begin shaping both inflation and growth within a managed cycle, all in service of a greater goal: regaining control of supply chains and restoring America's global economic dominance. In that context, multinational corporations will have to navigate a constantly shifting policy landscape where interest rates, subsidies, and tariffs are strategic bargaining tools. Investors should abandon any illusions of long-term Fed independence. The market itself will apply the pressure. Make no mistake, Trump is not attacking China. He's challenging the resilience of U.S. neutral institutions like the Federal Reserve. If the Fed yields, Trump won't just control economic policy, he'll dominate the media narrative and public expectations. This is a reversal of roles. The president becomes the indirect architect of monetary policy, steering market psychology to shape national outcomes. And if it works, it may set a global precedent for populist governments everywhere. The 90-day inflation trap isn't just a short-term tactic, it could become the very tool that reshapes the entire U.S. economic framework for the next decade. Part 3: China, a tactical retreat to buy time for counteroffensive. Why did Donald Trump, a president famously known for never backing down, choose to call a truce with China just as the U.S. economy reported negative growth? The answer doesn't lie in weakness, but in a clever strategy, a policy trap designed to gain control over both the Fed and the market. The 90-day suspension of tariffs wasn't a concession, it was a deliberate move to manipulate inflation expectations and pressure the Fed to step back. With tariffs on hold, input cost pressures ease, and the consumer price index CPI cools in the short term. That's when the media, the markets, and corporate voices unite to say, inflation is down, cut rates now. If the Fed complies, Trump gets exactly what he wants: lower interest rates, right as he plans to inject funds into domestic industrial programs, something he was unable to fully do during his previous term due to Jerome Powell's resistance. Unlike 2019, Trump this time doesn't just apply verbal pressure. He uses policy, and more importantly, market psychology, to steer the Fed's decisions. And the interesting part is the market is doing the work for him. Within 48 hours of the deal's announcement, Nasdaq jumped over 4%. S&P 500 rose nearly 3%. Gold prices softened, bond yields fell, all pointing toward a shared belief that the Fed would soon ease policy. That's when Trump can proceed with his next move. If the Fed cuts rates, he can reimpose tariffs, this time deeper and broader, with minimal backlash from a preconditioned market. At that point, Trump would dominate all three levers of macroeconomic power: monetary policy via the Fed, fiscal policy via stimulus, trade policy via tariffs. No U.S. president has held that kind of coordinated control since Nixon. With legislation like the CHIPS Act and the Inflation Reduction Act (IRA), the Trump administration could accelerate domestic manufacturing, protect strategic industries, pull supply chains out of China, and reshape the U.S. economy under the doctrine of industrial sovereignty. Now the key question is, will the Fed yield to this trap? Jerome Powell might try to uphold neutrality. But if, over the next 2 months, inflation decreases, unemployment stays flat, and markets continue to climb, Powell could be cornered by the market itself, dragged toward Trump's direction. And if that happens, Trump gains not only economic momentum, but also political leverage for broader strategic moves: reinstating tariffs, reopening trade negotiations with Europe, redefining the global role of the U.S. dollar. The real concern isn't what Trump will do next, but that he's already prepared for it all, with a calculated strategic step backward. Moreover, if the Fed cuts rates, Trump can begin to fine-tune both inflation and growth in a controlled cycle, serving his ultimate goal: reclaim supply chain sovereignty and reassert U.S. economic dominance on a global scale. In this volatile setting, multinational corporations will have to brace for a policy environment where interest rates, subsidies, and tariffs all become strategic bargaining chips. Investors should also abandon the notion that the Fed can stay truly independent, because it is now the market itself that is exerting indirect pressure. Trump isn't attacking China directly, he's testing the resilience of what's supposed to be a neutral institution, the Federal Reserve. If the Fed caves, Trump would effectively control the economy, the media narrative, public expectations. This is a role reversal. The president becomes the de facto conductor of monetary policy by mastering market psychology. And if successful, it could become a global playbook for populist governments. The 90-day inflation trap is not just a short-term tactic. It may very well be the tool that reshapes the entire structure of U.S. economic policy for the next decade. Part 4. Technology and supply chains, the silent, existential battlefield. If trade is the visible front, then technology and supply chains are where an invisible war is unfolding, long, slow-burning, but immensely brutal. Behind every electronic component, every semiconductor chip, every shipment of rare earths lies the defining question of the 21st century: who controls the future? During the 90-day tariff pause, the flow of goods between the U.S. and China was temporarily restored. But experts know trust in supply chains can't be rebuilt with a short-term deal. In fact, this period has only accelerated global corporations' push for strategic decoupling. They're no longer asking, when will the U.S. and China reconcile? They're now asking, how do we exit China and who replaces it? Technology is the epicenter. Major firms like Nvidia, Apple, Intel, Tesla are deeply reliant on Chinese manufacturing and assembly. But with export controls, the CHIPS Act, and bans on high-tech exports, they're being forced to diversify. TSMC is building new fabs in the US and Japan. Samsung is expanding in India. Foxconn is betting big on Vietnam. Rare earths and critical materials, the stealth weapon. China has previously threatened to cut off rare earth exports vital for EVs, batteries, radars, and AI. In this 90-day window, Beijing suspended the ban but offered no long-term guarantee. The US, Japan, and the EU are racing to secure alternative supplies from Africa, Australia, Canada, and notably, Vietnam. Supply chain realignment. Vietnam, India, Mexico, and Indonesia are emerging as strategic alternatives. Foreign direct investment is flowing to regions with political stability, competitive labor, and proximity to major consumer markets. Vietnam, in particular, stands out in electronics, supporting industries, and semiconductor assembly. What are the long-term implications? This isn't just about shifting factories, it's about redrawing the map of global industrial power. The US wants to control both inputs and outputs, from raw materials to design, manufacturing, and consumption. China is pushing for complete technological self-reliance, developing domestic alternatives to US technologies. Caught between these two giants, developing countries, especially Vietnam, are no longer just investment destinations. They are becoming strategic crossroads in the 21st century economic landscape. But nations must stay clear-eyed. No agreement can save a business that relies on a single supply chain. The real survival traits are flexibility, partial localization, geopolitical responsiveness. During this 90-day window, some companies may rush to resume orders with China, but strategic firms are using this time to relocate steadily, decisively, and irreversibly. The market sees the flames, but strategists see the path beyond the fire. A bigger question emerges: if neither the US nor China intends to maintain the current global supply chain model. Are we witnessing the end of globalization as we know it? Or merely a reallocation of power along geopolitical lines? Over the next 5 to 10 years, new industrial centers will rise not based on low labor costs but on geopolitical risk management, digital infrastructure, reliability, and international agreements. Countries like Vietnam could become major winners, but only if they pursue institutional reform, clear national strategy, agility in adapting to core global technologies. Businesses at every level must now understand there is no such thing as a sustainable supply chain, only supply chains flexible enough to continuously adapt. And this short 90-day window, it's the perfect moment to remap the entire supply chain before the next major shock arrives. This shift isn't just about corporate decisions. Governments, too, are rewriting their economic security strategies. Traditional FTAs, free trade agreements, are giving way to regional pacts with built-in supply chain security, like the Indo-Pacific Economic Framework (IPEF), where Vietnam plays a crucial role. Simultaneously, the trend of friendshoring, moving supply chains to trusted allies, is turning Southeast Asia, especially Vietnam, into a vital hub in the global restructuring effort. This opens the door to rapid development, but also presents enormous challenges. Infrastructure bottlenecks, workforce quality, national risk management capacity. In this grand narrative, the 90-day deal is not an ending, but a brief pause before a far more intense, global race. One no longer limited to trade or tech, but spanning every strategic frontier. It's a stress test for every economy on Earth. Those who prepare in advance will be the ones who survive. Part 5. 3 scenarios after 90 days. Where will global financial markets go? The 90-day agreement between the US and China may be a temporary effort to cool markets and stabilize global sentiment, but in reality, it opens up 3 very different strategic pathways. Below are the 3 major scenarios that could unfold and their potential impact on the financial world. Scenario 1. The US reimposes tariffs. Fed has cut interest rates. This is the scenario Trump is actively pursuing. During the 90-day pause, the CPI may cool thanks to the suspension of tariffs. Under market pressure and public sentiment, the Fed may concede and cut interest rates once or twice. Once he secures that low-rate cushion, Trump could reintroduce tariffs on a larger scale. But this time, the markets would likely react less severely, having already been reassured in advance. In this scenario, the US administration would gain control over all 3 levers of power: monetary policy via rate cuts, fiscal policy through expanded spending room, trade policy via tariff tools. Impact: stock markets would be volatile, but likely rebound quickly. Gold would rise again, the US dollar would strengthen, and capital would flow back into safe haven assets. Multinational companies would accelerate their exodus from China, and FDI would flow into Southeast Asia, especially Vietnam, India, and Mexico. Scenario 2. Both sides extend the truce. The policy blind spot continues. This is the cautious, low-risk, but also low-resolution scenario. Both parties maintain dialogue, but make no further commitments. Markets would see stability, but core issues like tech transfer, supply chains, and rare earths remain in the danger zone. Impact: markets drift sideways or recover slowly. Investors stay defensive, rotating capital among safe haven assets. China uses the time to stabilize internally, while the US prepares for its next policy cycle. Scenario 3. The deal collapses. Conflict returns, stronger than before. This is the most dangerous scenario. If China is accused of violating the agreement or takes aggressive steps, for example, cutting off rare earths, imposing non-tariff barriers, the US may retaliate with sweeping tariffs broader and more aggressive than those in 2023. Impact: US and global stock markets plunge. The VIX Fear Index surges. Inflation returns. The Fed is trapped. It can't hike rates due to slowing growth, but also can't cut due to rising costs. Hedge funds flee emerging markets. Even countries like Vietnam, while benefiting from supply chain shifts, would feel the pressure of capital outflows. Action strategy for investors and businesses. Maintain high flexibility. Don't allocate capital based on just one scenario. Prioritize cash, gold, or high liquidity assets. Stay neutral in investment positioning, but be ready to pivot rapidly if scenario 1 or 3 plays out. Businesses should develop Plan B supply chains, diversify vendors, and prepare for extended disruptions. But what if none of these scenarios fully materializes? We must also consider a more realistic case. The global financial system might not fall neatly into any of these clean outcomes. Instead, a hybrid picture may emerge. The US may cut interest rates without reapplying tariffs. China may honor its commitments but cause indirect disruption. Markets may rebound yet remain jittery over secondary inflation risks. In a world of rising geopolitical risk, forecasting is no longer about certainty. It's about being ready for what you didn't expect. Macro investors must shift their mindset from finding perfect entry points to building shock-resilient systems. The market won't wait for you. It will adjust whether you're prepared or not. And in this high-stakes game, the winners won't be the smartest or the boldest. They'll be the calmest, most adaptable, and the ones who truly understand the framework they're operating within. Closing thoughts. You've just listened to a long-form strategic analysis, but we believe that in today's chaotic world, depth is rare and deeply valuable. If you found this episode insightful, please share it. And don't forget to follow the channel Decoding the Times to stay with us through more clear-eyed, grounded, and strategic takes on global finance, economics, and geopolitics.